Welcome to Every LA Talks with Los Angeles real estate agent Matthias Baker Mazzucci.
All right, let's talk about return on equity and why your best property might be underperforming. Ashley, what is return on equity?
Yeah, so return on equity is having you look at what is your total net income at the end of the year, and you want to take into consideration your mortgage expense. What is that related to the total equity you have in a property? So I'm going to give you an example. Let's say you have $1 million property and $200,000 in debt. That's an $800,000 equity position in that property. Well, now let's say you're earning $10,000 a month on that property. Well, now you're earning $120,000 a year on that property. That would be a pretty good performing asset. You know, that's 120,000 divided by 800,000. Well, now let's take that one step back. Let's say that your equity in that same property is $2 million. Well, look at how that impacts your return on equity. And that's what we want to understand with your real estate is how well is your real estate performing? Most assets today, you're going to want to see somewhere around 5%. And if it's lower, we want to understand why. Are you in a strong appreciating market? What's your position? But that return on equity is just one of the indicators that we can look at as to whether or not you can reposition your portfolio and maybe earn more money on an annual basis.
Absolutely. And it's a perfect example. Appreciation is tricky because you bought your property for $1 million in 2018. And it was returning pretty good when you bought it, but now it's worth $2 million. And the returns they have not doubled. Chances are they have not doubled. So you got to ask that question. Keep this in mind. This is how we feel. This is how investors feel. A lot of people feel. Your equity should work as hard as you do. Equity's got to work. You know, like if you have a building where you have very little equity in it, you have a mortgage, it's $1 million and you have a mortgage for $900,000 on it, then you don't have much equity in it. There's not much we could do about it. But if you find yourself having a lot of equity, it's time to reposition your capital. It may be time to reposition your capital. So keep that in mind. Thank you for, right. Did you have anything else to add?
I do. So, a lot of times I work with clients. I'm a DST advisor. We're looking at 100% passive investment strategies. I always run return on equity with clients just so that they understand whether they want to do an exchange and whether or not DSTs would be a good fit. I will tell you that 2 out of 3 times today, I can confidently tell an investor that a 1031 exchange is going to double, if not triple, your return on equity. That is a big That's a big number to understand. That's a lot more income, especially for those who are going into retirement and they're trying to structure their portfolio to support them through retirement. What if you could go from earning $10,000 a month to $20,000 a month? What could that do for you? And so those are the things that you really do want to understand.
Absolutely. Thank you for joining us with this video, but feel free to reach out if you have any more questions. We're here for you. And if we don't hear from you before the next video, then we will see you in the next video. All right, bye.
Thank you for watching. To find out more, visit everyla.com.